For years, the whole story around XRP felt like it was just tied to social media hype and scary regulatory headlines. But what if the real things driving its value have absolutely nothing to do with what the public is talking about? In this explainer, we're going to dive into the data and uncover the hidden forces that suggest XRP's price is starting to break away from that common narrative.
So what's the big disconnect here? What are the big money institutional investors seeing in XRP that maybe the average person is missing? Well, the answer really comes down to the difference between noise and signal.
And this slide, it lays it out perfectly. On one side, you've got the common story everyone hears, the scary SEC lawsuit, fears of constant token dumps, and all the retail hype. But on the other side is the institutional reality, things like legal clarity, actual supply constraints, and XRP's role as, the plumbing of global finance. Let's break down these two completely different worlds, starting with the biggest myth of all.
For the better part of 5 years, the story of XRP was the story of its fight with the SEC. Everyone saw it as this total regulatory nightmare, an asset that was just paralyzed by legal drama. But how that battle ended, it completely changed the entire landscape.
Just think about it. This one single question, is XRP a security, was like a giant wall holding back a flood of institutional money. It kept U.S. exchanges from even touching XRP and made any kind of large-scale adoption pretty much impossible. Everything, and I mean everything, hinged on the answer to that question.
And the stakes? They were huge. The SEC didn't just walk in. They came in swinging with a demand for $2 billion. A number like that sends a message to the market that the regulator is going for a knockout punch, which just reinforces that feeling of catastrophic risk.
But just look at where it all ended up. A final settlement of only $125 million. I mean, the sheer scale of that drop is the whole story. This wasn't just a win for Ripple. It was a massive de-risking event for the asset itself. It signaled that the long, dark cloud of uncertainty was finally gone.
So, what did this settlement really do? Well, first off, it confirmed that XRP itself is not a security. That was the green light exchanges needed to relist it. But second, and this is a big one, it restricted Ripple from selling huge, unregistered blocks of XRP to institutions. Kind of weird, right? But that actually created a supply crunch, forcing those big buyers to go to the open market just like everyone else.
And that brings us right to our next myth. This idea that a billion XRP are just dumped on the market every single month, pushing the price down forever. This story has been around for ages, but the actual on-chain data tells a very, very different story.
So the narrative goes something like this. On the first of every month, 1 billion tokens get unlocked from escrow, and poof, massive sell pressure. It's a simple story and it sounds pretty scary, but it leaves out the most important part of what actually happens next. Here's the reality. Of that 1 billion XRP released, the vast majority, we're talking around 80%, is immediately put right back into new escrow contracts and relocked. So the actual net new supply that could even potentially hit the market is just a tiny fraction of that headline number. It's a figure the market has shown time and again it can absorb pretty easily.
And get this, while that small amount of new supply is entering, something else is happening at the exact same time. Every single transaction on the XRP ledger actually burns a tiny amount of XRP. It's gone forever. This means the total supply is always slowly decreasing over time, which creates a deflationary pressure that fights against that inflation story.
Okay, so we've busted the biggest fears. Now let's get to the good stuff and build the positive case. The institutional reality isn't about hype or tweets. It's about infrastructure. It's about XRP's role as a piece of the new plumbing for global finance.
And it all starts with this term, ISO 2022. The easiest way to think about it is this. It's like all the world's banks finally decided to speak the same modern digital language. It is a massive upgrade for the entire financial system, and XRP was literally designed from day one to be compliant with this new standard.
Now, here's a mistake a lot of people make. They think XRP is here to replace SWIFT. That's not the game at all. SWIFT is the messaging system. It sends the instructions, like pay this person this much money. XRP is a settlement asset. It actually moves the value. Because they now both speak the same ISO 2022 language, they can work together, letting the instruction and the actual money move at almost the same time.
And the hard data? It shows this decoupling happening in real time. During a period where institutional funds were pulling money out of other digital assets, they were pouring nearly $900 million into XRP-based products.
This isn't retail FOMO. This is big money allocation. It's based on a completely different set of facts.
So why is this so important? Well, spot ETFs don't just track the price. They have to go out and physically buy and hold the actual underlying XRP. Every single dollar that flows into an ETF literally pulls tokens off the open market and locks them away. This creates a supply shock where you have growing demand chasing a shrinking pool of available XRP.
So let's bring this all home. When you push past the old stories and you look at the actual mechanics of the regulation, the supply, and the institutional adoption, a very clear picture starts to form. This great decoupling isn't just a theory. It's what happens when you see a fundamental shift in who is buying an asset and, more importantly, why they're buying it.
This table really just sums up the whole thing. The retail narrative sees monthly dumps. The institutional reality sees that 80% of it gets relocked. The narrative sees a terrifying lawsuit. The reality sees that XRP is now one of the only assets with actual regulatory clarity in the United States. This gap in information, it is the entire story. While one side is trading based on old news, the other is putting capital to work based on the hard realities of supply, demand, and utility.
And that really leads us to one final question. As the very plumbing of our financial system gets a complete rewrite, the most valuable information isn't always the loudest. So what is the real value of actually seeing the data that's been hiding there in plain sight all along?